Right now, while you're asleep, your money is working a full-time job. It's lending, it's earning, it's being multiplied across a dozen accounts you will never see. There's only one problem: you're not the one getting paid. We're all raised on the same story. You put money in a bank and it sits there, in a vault, with your name on it, waiting for you, safe. That story is comforting. It's also completely false. The moment your paycheck lands in your account, your money stops being yours in any physical sense. It becomes fuel. The bank takes almost all of it and pushes it back out into the world as car loans, mortgages, credit lines, and overnight bets you'll never hear about. And in 2025, the U.S. banking industry made $295 billion in profit doing exactly this. That was up more than 10% from the year before, one of the most profitable years in the history of banking. Meanwhile, the savings account your money came from, at the biggest banks in America, it pays you somewhere between 0.01% and 0.5% a year. Let that sink in. The industry earns hundreds of billions. You earn pennies, and it's the same dollars doing the work. That gap between what they earn and what you earn is not an accident. It is the entire business model, and it has a name. It's called the spread. The idea is brutally simple. The bank takes your deposit, pays you almost nothing for it, and lends it to someone else at a far higher rate. The difference is pure profit. Let me make it real. You put $10,000 into savings. The bank pays you maybe $5 a year. Then it lends that same $10,000 out as part of a car loan at 7% or a credit card balance at 24%. You earned $5. They earned hundreds on your money. In the last few months of 2025, the average spread across all U.S. banks hit 3.39%, the widest it had been in years. And here's the quiet part. When interest rates finally started falling, the banks lowered what they paid you faster than they lowered what they charged everyone else. The spread didn't shrink, it grew. Now, you might be thinking, fine, it's their building, their license, their risk. They earn the difference. That's just business. But the spread is only the surface, because the bank isn't just lending your money once. It's not even just lending your money. It's lending money that doesn't exist yet. This is the part that sounds like a conspiracy theory, but is written plainly in every economics textbook. When you deposit $1,000, the bank doesn't lend $1,000. It keeps the small slice and lends out the rest, say $900. That $900 gets spent. It lands in someone else's bank. That bank keeps a sliver and lends out around $810, which gets spent, deposited, and lent again, and again, and again. Your original $1,000 has now become thousands of dollars moving through the economy. New loans, new debt, new spending. Economists call it the money multiplier. The banking system as a whole creates far more money than was ever actually deposited. Stop and picture that. The money in your account isn't sitting in a drawer. It's been split, copied, and stretched across a chain of strangers. A borrower buying a car, a shop owner making payroll, a family closing on a house, and every one of those transactions traces back to the deposit you forgot you even made. Every link in that chain earns the bank interest. Every link is built on you. And here's where it gets darker, because there used to be a rule that limited how far this chain could stretch, a hard limit, and in 2020, that rule quietly disappeared. For over a century, there was a guardrail. It was called the reserve requirement. The law said a bank had to physically hold back a percentage of every deposit, usually around 10%, and keep it in reserve. It couldn't lend out everything. That reserve was the safety net, the thing standing between you and an empty vault if everyone showed up to withdraw at once. It wasn't a small rule. It had been part of American banking since 1913, the year the Federal Reserve was created. Through the Great Depression, through 2 world wars, through 2008, that guardrail held. Then, on March 26, 2020, in the middle of the pandemic panic, the Federal Reserve did something most Americans never heard about. It cut the reserve requirement to 0%. Not 5%, not 3%, 0%. For the first time, U.S. banks were under no legal obligation to hold back any of your deposit at all, and the Fed has said that has no plans to change it back. Now, banks still keep some cash on hand because they need it to function day to day, but the requirement, the legal floor, was gone, erased. While the country was distracted by something far louder, the oldest rule in modern banking was switched off, and almost nobody noticed. Which brings us to the real question. If your money is being lent out all day, what does it do at night when the loans stop and the lights go off? Here's the part almost nobody understands. At the end of every single day, banks are left with piles of cash they haven't lent out yet, billions of dollars just sitting there overnight. So they don't let it sit. They hand it to the Federal Reserve itself, and the Fed pays them interest on it risk-free every night. Right now, that overnight rate is around 3.6%, guaranteed, no risk, no effort. The bank doesn't have to find a borrower, run a credit check, or take on a single ounce of risk. It just parks the money and collects. Think about what that means. The bank pays you 0.01% on your deposit. Then it takes that same money, parks it at the central bank overnight, and earns 3.6% risk-free while you sleep. That's not a typo. The bank can earn more on your money in a single night of doing nothing than it pays you in an entire year. And when one bank runs short overnight, it borrows from another bank that has extra in a massive invisible lending market that runs every single night between the largest financial institutions on Earth. Trillions of dollars changing hands in the dark, all built on the deposits of people who are fast asleep. There is an entire economy that wakes up the moment you go to bed, and you fund it every night, for free. Your money never clocks out. It just stopped working for you the second you handed it over. So what do you actually do with this? First, understand that your savings account is not storage. It is the cheapest loan you will ever give in your life, and you're giving it to one of the most profitable industries on the planet for almost nothing in return. Second, that spread is public information. The margin every bank earns is published in plain sight. You can look up exactly how much they keep, and you can move your money to where the spread is fairer. High-yield savings accounts, credit unions, treasury bills, places that pay you something far closer to what your money is actually earning out there in the dark. The difference on real savings could be hundreds or thousands of dollars a year. The same dollars, a different destination. The system isn't hidden, it's just quiet, and quiet is exactly how it stays this profitable. The bank isn't doing anything illegal, it's doing exactly what it was built to do. The only mistake is yours, assuming your money was resting when it was actually working overtime for someone else. If this changed how you see the cash in your pocket, subscribe, because on this channel we decode the systems that were designed for you not to notice. And next, I'm going to show you something even stranger, where the money goes when the bank itself runs out, and who they're really borrowing from when nobody's watching.